This is Linda Hitt. We are going to take a look at the closing entries for a company that sells a product. We're still closing out revenues, expenses, and dividends. We do have some new titles. In a manual system, if you remember, at the very end of the period, we close after we do the year-end income statement. If we close before, then we lose those temporary counts. So in the process, we should be updating our retained earnings to the ending balance and getting ready for next year, because then the temporary counts can capture just next year's data. Closing entries are done in a process of journal entries on the same general journal paper in a manual system that you used before. So we look at all temporary counts and basically do the opposite in the journals, and everything gets moved eventually into retained earnings. If you use an income summary account, you're closing revenues into income summary, closing expenses into income summary, and then closing income summary into retained earnings. It's just an extra step. We are not going to use the income summary account, and then dividends are closed as a separate thing. The end result is in the general ledger, your same ledger you used before. Your temporary count should all have zero ending balances. That's why we need them zeroed, because we start all over again next year. And during the year, we did not debit or credit retained earnings. So now, with closings, we have finally updated the retained earnings account for those temporary counts. So let's go ahead and take a look at our problem and go from there. So if you remember, or if we looked at the previous video clip, it doesn't matter if you did not. We took the general ledger amounts, we transferred them over to the trial balance in the middle, and then we did an income statement among the three statements. We did other statements as well. When you do closing entries in a manual system, you can be looking at either the general ledger or trial balance or income statement, because they contain most, if not all, of what you need. Personally, I prefer looking at the trial balance. I don't know, it's kind of all there right together. If you've done it in a certain order with the statement order, then it makes it easier. And you also know your debit credit rules, so it's just a thought. I'm going to do one big giant closing entry. I'm going to take all temporaries and get rid of them. So basically, the end of the bottom of the trial balance is what we're going to get rid of. You'll notice the top part is the permanent accounts, your assets equals liabilities, stockholders' equity, and the bottom is your temporary accounts. If you've organized it, you don't have to do it that way, but it does make life easier. So in a closing, you do the opposite. So if you close out sales, it's a revenue, so I'm going to have to debit sales for the amount because it has a credit balance. And right now it's the only thing that has a credit balance. So I'm going to skip a space because we'll eventually, actually I can just put retained earnings. Well, I'll skip a space. Retained earnings could be either a debit or a credit. And then we can look at the contra revenues. They are very similar to expenses. They have debit balances, so to get rid of those, and you do want to close out temporary revenues, or contra revenues, you want to take the accounts and credit them. So we have 200 for sales returns and allowances. We have only 40 for sales discount, so those are credited. And then each individual expense account would also be credited, because you're doing, again, the opposite. So $29.40 for cost of goods sold. Freight is 70. Whoops, don't want to do that. We have a loss. Loss is an expense account. And that's the $49. The revaluation of inventory using lower cost or market is the LCM expense. And interest, your finance charges. Okay, so there's your giant closing entry, a compound entry. And what we should expect to see, I didn't leave a space, did I? That's okay. If you look at your income statement, we would expect, we did have a profit, which is good news, that our retained earnings should go up for the net income, and if we had a dividend, it would go down, and we did not have any dividends. So I'm fairly safe to assume that this would be $15.95. Now we should be able to prove that, and I can check the work here and do the math. So let's see what we get. Let's do the credit side. So we have 240, 29, 40, 70, 49, 1206, 100, and 15.95. Okay, it does come out to be 6,200, so that's good. If it doesn't, again, for your purposes, spend 5 or 10 minutes. If it doesn't balance, just let it alone. Don't worry about it. Okay, so we just closed the books. So then we would go to the general ledger, which is right here. I think we can still hopefully see the numbers. And all the ledger accounts that you've been using. When you close the books, you don't, of course, close assets or liabilities, but these would be to close. So, for example, the sales revenue would have a debit, and that would make your ending balance 0. Freight you would credit, and that would make your ending balance 0. Sales returns and allowances would be credited, ending balance 0. And inventory loss credited, ending balance 0. Let's see, who else do we want to zap here? Sales discounts credited, ending balance 0. Lower cost of market expense, ending balance 0. Cost of goods sold, we don't have much space here, but it would be $29.40, and the ending balance would become 0. And interest expense, that would be offset. It's all part of that journal entry. Interest payable is a liability. Of course, store equipment, those are assets, so only the temporaries. Don't get carried away. I've seen students actually close everything, which is not good. So retained earnings has $15.95, so retained earnings should now go up. And it's all been just sitting there with nothing in it. So here's the opportunity to increase it for the profits that you made, because again, it goes up for revenues, down for expenses, down for dividends. So what this virtually does is to wipe out the bottom part of the trial. So the last trial balance, post-closing trial, we lose all the temporary counts. The retained earnings has been updated, and we do totals once again. So if I do auto sum, might as well do it at this point. Again, hope for the best. Thank goodness software does this for us. Okay, if they balance, then that's what you want to see. And it means that this is the final trial balance, which is referred to as the post-closing trial. And you're all set for next period. You've done your statements for this year, you've closed the books, you've got your permanent accounts carrying over to next period, which is showing up, of course, in your trial, and your balance sheet, your accounts, you need the beginning balances to figure out the endings. So this concludes the video clip on closing entries.